NDX options will start to trade PM settled on February 2nd. I'm Jill Malandrino, global markets reporter at Nasdaq, and welcome to Trade Talks. Joining me at MarketSite is Tony Zhang. He is the chief strategist over at Options Play. Thank you, as always, for joining us. Let's get right into it, Tony. Transitioning from AM to PM dates on the NDX options, what does that mean for traders?
Yeah, so like you said, on January 26th, we're going to have the last AM settled NDX weekly options expire. And going forward in February, we're going to move to the PM settlement. And just for clarification, AM settlement means these are the index options where you can trade up until the Thursday's close, but they don't settle until the Friday's opening price. Versus PM settlement is where you can trade them all the way up until Friday's close, and they settle based on the Friday's closing price.
So you don't have the overnight risk then?
Exactly. So we're removing that overnight gap risk and makes it more in line with regular stocks and ETF options, which is a little easier to manage around expirations. But the one thing I do want to point out is that if you're trading NDX options, if you're trading the monthlies and the weeklies, the monthlies still remain on the AM settlement for now. So if you're trading both, you have to be careful whether you're trading either one to make sure you know which expiration is which.
So if you're like on a 4-week cycle, within first, second will be PM, third week AM, fourth week PM.
Exactly. So you have to make sure you switch between the two. And the other thing to keep in mind is the fact that when you're trading these options, there's also a tax advantage that you have over the regular stocks and ETF options that you have.
All right, let's get into some strategies, and two big strategies that traders like when it comes to weekly options are selling put and call credit spreads. So why are these popular with traders before we even get to the strategies themselves?
Yeah, so these strategies are very popular with technical traders or relatively short-term traders. And before I get into kind of how they trade them, I'll talk a little bit about these two strategies. So when we talk about selling a put credit spread, this is the strategy that you would use when you have a neutral to bullish outlook on the markets. This is where you're selling a slightly out-of-the-money put and then buying back a further out-of-the-money put. Versus if you're selling a call credit spread, this is a strategy that you would use if you have a neutral to bearish outlook on the overall market. This is where you're selling a slightly out-of-the-money call and buying back a further out-of-the-money call. And the reason that technical traders like to use these two strategies is because they can effectively string these two strategies along as they feel the markets are reaching a bottom or reaching an oversold area. They would typically sell a put credit spread, and as the markets rise and hits where they feel it's a top or overbought levels, they would sell a call credit spread, and they can essentially keep stringing these two strategies back and forth as the market moves up and down. And that's really why these strategies are very popular with the short-term traders.
So these work well in a low or high volatility environment.
Yeah, so this is actually a question that I get a lot, meaning, should you only sell credit spreads in high volatility environments? And while high volatility environments are good times or the best times to sell credit spreads, I think it's important to understand that even in low volatility environments, it's still worthwhile to consider selling some of these credit spreads, even though we're in a low volatility environment.
All right, and are there differences with the strikes, weeklies versus monthlies? Will there be more strikes added for the weeklies?
Yeah, so generally what we tend to find is because the weeklies are listed in such short periods, we tend to have a lot more strikes around the at-the-monies. So because between the fact that you have the weeklies, which gives you a lot of flexibility on time, and the fact that there's a lot of strikes, that's really why short-term traders tend to gravitate towards the weeklies, because they have a lot of the ability to fine-tune their strategies both on a time frame and on a strike level using these weekly options. And you can find them still on the same chains through the NDX chains. They're just now going to be trading on the new symbol NDXP.
All right, and to wrap up, and I'm sure you get this question all the time, since the NDX represents the top 100 non-financial Nasdaq-listed names, so your big tech names that have been really driving the market in 2017 and even 2018, are these good to hedge with to protect those gains that we've seen?
Yeah, so we talk to a lot of advisors at Options Play, financial advisors that deal with clients who have large concentrated stock positions, and a lot of times we are seeing them in tech names now, more and more. So we're seeing more and more portfolios have a higher correlation to the Nasdaq 100 index these days, which makes the NDX index options a vehicle for potentially hedging and even for some income generating opportunities. So if you're looking to protect a portfolio in a tech heavy portfolio, you can buy some puts on NDX options going out a couple of months. Or if you're looking to sell some calls, but you don't want to have the risk of that stock being called away, you can actually sell some naked calls on NDX and still get the same income without having the risk of losing that stock on the other side.
All right, well, thank you very much for joining us as always. And traders, thank you. I'm Jill Malandrino, global markets reporter at Nasdaq.